Right now, Congress is looking at a bill that could let some homeowners sell their house and exclude up to $1 million in gain from taxes. Sounds great, but before everybody starts celebrating, let me slow you down for a second. Number one, it's not law yet, it's a proposal. Number two, even if it becomes law, it does not solve the biggest problem I see when people sell highly appreciated homes, because the capital gains is usually the tax people are expecting. The real damage is in what we call a tax cascade that happens afterward. It can affect your Social Security, it can increase your Medicare premiums 2 years later, it can trigger a 3.8 net investment income tax, boom. It can bump you into higher brackets, and in some cases, people don't even know that they created the problem until after the deal is closed, a letter shows up in the mail, sometimes a couple years later. So today I want to walk you through what the bill actually does, who it helps, who it does not help, and what you should be doing before you sell a house to minimize surprises. Because once you close, a lot of the best planning options are gone. I'm Toby Mathis, I'm a tax attorney, and I've been watched people do everything right for decades. They buy a home, they pay it off, they watch it appreciate, and then they get hammered because they did not plan before they sold. Let me get into this. There's a bill in Congress. It's called the Nest Egg Protection Act. The idea behind it is actually pretty simple. It's if you're 65 years or older and you've owned your primary residence for at least 25 years, the bill would temporarily increase the home sale exclusion to $1 million. That would apply whether you're single or married. Now that's a big deal because under the current law, Section 121 of the Internal Revenue Code, when you sell your primary residence, you get to exclude up to $250,000 of capital gain if you're single, or up to $500,000 if you are married filing jointly. And by the way, those numbers have been around since like 1997. That's the part a lot of people miss. They weren't indexed for inflation. 1997, that's when I became an attorney. It's almost 30 years ago. Home values have changed just a little since then, and by a little, I mean in some markets they've doubled, quadrupled, even more. So imagine somebody bought a home 30 years ago. They weren't speculating, they weren't flipping houses, they were not doing anything exotic. They bought a house, they raised their family, they paid the mortgage, maybe they put on a new roof, they remodeled the kitchen, they added a bedroom, and now they want to downsize. They go to sell, and all of a sudden they find that the gain over $250,000 or $500,000, hey, that might be taxable. And this is what Congress is trying to address. The policy argument is this: seniors are sitting on homes with large unrealized gains. They want to move out, but they don't want to get hit with the big old tax bills, so they stay put. That keeps inventory off the market, younger families can't buy those homes. So the bill is designed to do two things: help seniors keep more of the equity that they built, and hopefully more homes go back onto the market to new buyers. Now there are other proposals flying around too. Like there's some that double the exclusion amounts that exist right now. There are proposals to index the 121 exclusion, the $250,000, $500,000 to inflation, which would be really smart. I don't know why they didn't do it in the first place. There have even been proposals to eliminate the home sale tax altogether. But here's the part you need to remember. These are just proposals. They're not law. They may pass. They may die in committee. They may get changed. They may get narrowed. They may never see the light of day. So don't build your retirement plan around Congress doing something helpful. It may never happen. It's generally a bad strategy. And even if this bill passed exactly as it is written, it's still pretty narrow. You have to be 65 years or older, and you have to have owned the primary residence for at least 25 years, and it's temporary. It's only for a couple years, and it only addresses the capital gain exclusion. It does not fix the tax cascade that happens when you sell a property, and that's what I want you to really understand. When you sell a home with a big gain, you are not dealing with just one tax. You may be setting off a chain reaction. Let's walk through it. Number one, Social Security. So people will ask, Toby, if I sell my house, Do I have to pay Social Security tax on the gain? The answer is big old whopping no. Capital gains are not wages, they're not self-employment income. So you're not paying payroll tax or self-employment tax on the gain from selling your house. But what it does do, because this does not mean that Social Security is unaffected. What happens is the gain from the sale of your house, the taxable portion of it, increases your income for the year. And when your income goes up, more of your Social Security benefits can become taxable. Up to 85% of your Social Security can be included in taxable income. That's not a Social Security tax. It's an income tax on your Social Security. It's a different door, but it's the same pain. Second, Medicare. We're all going to get to play with this one. This is the one that catches people off guard. There's something called IRMAA, Income-Related Monthly Adjusted Amount. This is a surcharge that gets added to Medicare Part B and D premiums when your income's too high. And IRMAA is nasty for two reasons. First, it uses a 2-year look back. So if you sell your home in 2026 and there's an income, the income spike may affect your Medicare premiums in 2 years later, 2028. You may have completely forgotten about the home sale by then. And then you get a letter saying your Medicare premiums are going up. You're going to say, what in the world is this? It was the home sale from 2 years earlier. Second, IRMAA is a cliff. It's not a smooth phase-in. You go $1 over the threshold and you get to jump into the next surcharge tier, $1. And that's what drives people crazy. That $1, you could pay hundreds and sometimes thousands more in Medicare premiums. And remember, this is Medicare. We're not talking about Medicaid. People mix those up all the time. Medicare is the health coverage most people get when they're 65 years or older. Medicaid is needs-based. So we are talking about Medicare premiums. And a big home sale can make those premiums jump up 2 years later. Third, the NIIT, Net Investment Income Tax. They call it the Obama tax, whatever you want to call it. It's the extra 3.8% tax that applies when your income is above certain thresholds. For most people, the thresholds are $200,000 if you're single, $250,000 if you're married filing jointly. If your taxable home gain pushes you over those numbers, you're going to owe an additional 3.8 on top of regular capital gains tax. And most people never talk about this when they're sitting at the closing table. They're thinking, what is my capital gains? They're not thinking, is this going to trigger NIIT? Fourth, you get bracket bumping. I'll just say bracket bump. Because a big gain can move you from a 0% capital gains bracket that you might be used to in retirement. You go up to the 15%, sometimes it may go 15 to 20%. You may go from 0 to having a 23.8 with the NIIT on your capital gains. And it can also phase out deductions or credits, which can affect other tax items. And when you combine all of that, the real cost of the sale can be much higher than the seller expected. Now here's the part I really want people to hear. The IRMAA, the IRMAA, does have an appeals process, and there's basically certain life-changing events where you can ask for relief. Retirement could qualify, death of a spouse, divorce, but maybe loss of income-producing property could qualify, but selling your house generally does not qualify if it created a one-time income spike. So you don't want to be in a position where you sell the house, you get hit with a surcharge, 2 years later you're trying to unwind it. That's not planning, that's cleanup, and cleanup is usually more expensive and less effective than just doing the planning in the right time. So what do? Let's kind of walk through kind of a toolkit. Things that you can do to lower the impact of the sale of a house. Number one is maximize your basis. The taxable gain is not the sales price. This is where people get it wrong all the time. The taxable gain is the sales price minus your adjusted basis. And your basis usually starts with what you paid for the house, but it doesn't stop there. It gets adjusted. You get to add anytime you add improvements, like you put on the new roof, you add that. You added a new room, you add that to your basis. The cost of that room to the basis. You remodeled your kitchen, you add that to the basis of your home. You remodeled a bathroom, you add that to your basis of your home. You put on a new deck and you did some new landscaping, add that to the basis of your home. Get a new HVAC, add it to the basis of your home. Things that improve the property, extend its useful life, or adapt it to new use, all get added to your basis. You might also be able to add certain buying and selling costs. So if you bought a home for $300,000 and you sold it for $1.2 million, people are going to panic and say, my God, I've got a $900,000 gain. Maybe, but maybe not. We go look. Maybe you put $200,000 into improvements over the years. Maybe you have selling costs. Maybe your adjusted basis is much higher than you think. Every dollar you can document as basis is a dollar of gain that disappears. So that's why I tell people, please keep records on this. If you do not keep records, start reconstructing them before you sell. Look through your old bank statements, look through contractor invoices, the permits that you had to get, maybe you have records on that. Look through your emails. Call the contractor if they're still around. I've seen people reduce their taxable gain by 6 figures just because they finally went back and built the basis file. And this, by the way, this isn't aggressive tax planning. This is just doing the math correctly. Second, make sure you qualify for the exclusion. Under the current rule, you generally need to own and use the home as your principal residence for at least 2 of the 5 years before selling. If you're married and want the full $500,000 exclusion, you need to pay attention to both spouses. There are rules around ownership, there's rules around use, there's rules around whether either spouse has used the exclusion recently. This is where a little planning before the sale can really matter, and this is, like questions like, how is the home titled? Did both spouses live there? Did one spouse own it before the marriage? Was there a divorce? Was there a death? Because those facts actually matter. You don't just get rid of it. You look at the facts and you see whether you can qualify. Do not assume you get the $500,000 exclusion just because you're married. You got to check it. Third, consider something like an installment sale. This is one of those kind of weird underused tools. If you sell the house, you can take the money over more than 1 year. You can spread it out. If you take it all in 1 year, you get a giant income spike. And that's the thing. That income spike triggers the capital gains, NIIT, IRMAA, Social Security tax, bracket bumping, all of that in 1 year. But if you structure the sale as an installment sale, in other words, you spread it out over multiple years, 2, 3 years maybe, then we're still going to get that home sale exclusion, but the remaining taxable gain is recognized as it comes in. So you can help control the year-by-year income. Now, installment sales aren't magic. Obviously, there's some risk because you're getting paid over time. You're relying on the buyer to pay you. You need the documents, make sure you do it correctly. And you need to understand that there's interest income that you're going to be getting as well. You got to understand what happens if they default. Hey, I sold my house. They quit paying after 2 years. But from a tax planning standpoint, spreading income over several years can be very powerful, especially if you have a great buyer. Sometimes the issue is not whether you owe the tax. Sometimes the issue is when you owe the tax. So the timing can matter in that case. Don't ignore it. Talk to your accountant. Call us if you need to. I'll even put a free link in there. You can always ask questions of us. Have a free consult. I'll put a link into the show notes, or just write consult down below in the comments. If you do that, I'll just send you a link. Fourth, harvesting capital losses. So if you're selling a house and you have a large taxable gain from the home sale, you also might have some investments sitting at a loss. That might be the year to harvest those losses. Capital losses offset capital gain. So instead of just looking at the home sale in isolation, look at your entire tax picture. Look at your brokerage account. See if you have unrealized losses. Do you have carry forward losses on your return from prior years? Do you have a bad investment that you've been holding on to just because emotionally you don't want to let it go? The year of a large gain, that might be the year to just get rid of it. You could buy it back later, generally after 31 days, like just to make sure to be safe. Some assets like Bitcoin, you don't have to do that. But that might be the year to go ahead and harvest that loss to offset having a tax, so we can avoid getting hit here. Fifth, choose the year carefully. Don't sell blindly. If you know you're retiring, maybe the year after retirement is a better year than the year you still had wages. If one spouse is still working, maybe that timing really matters. If you're about to start Medicare, maybe the timing of the sale matters. If you're already on Medicare, remembering that 2-year look back, if you're planning things like a Roth conversion, maybe don't stack a huge home gain on top of a conversion unless you've really modeled it out to make sure it doesn't hurt you. Because this is where people get themselves in trouble. They're thinking, oh, I'm going to do a Roth conversion. I heard that was a really good idea. Then they sell the house. Then they realize all these gains. And then they have this big distribution taken out. And each one might make sense by themselves, but you combine them and you have a little bit of a tax bomb that goes off. So you got to look at the whole year. 6, for larger situations, look at some of the advanced planning. By the way, when you say advanced planning, this isn't do-it-yourself. You can know what these are, but you should know that the tools exist and then use a professional to help you with it. For example, a charitable remainder trust may make sense if you have really highly appreciated assets and you still have charitable intent. You want to spread income over time, provide an income stream, but you don't want to get killed with taxes. Maybe if the property, like you have a house that's really highly appreciated and you can convert it to a rental, you could use the 1031 exchange in combined with the 121 exclusion. You can actually do that. You got to sell it within 3 years generally after you quit making it your primary residence, but you can actually do that. Or how about a qualified opportunity zone investment? You could do that with certain gains, and every year, different years are better than others. 2026 might not be great. 2027 looks like it's going to be a great year to do those things. But these are tools that you choose to use in advance, not the week before closing. They require actual planning, and they require documents. They require timing, and they require someone who knows what they're doing. Don't do yourself on this. If the gain is large enough, it's really can be helpful to look at these things. And then there's a question that nobody asks, right? You're going to sell the house. Should you sell it? Sometimes we think we have to. Sometimes the best tax plan is not to sell. If you hold that home until death, your heirs are going to receive what's called a stepped up basis. And that means that the basis of that property steps up to the fair market value at death. So if you bought a home for $200,000 and now it's worth $1.2 million and you pass away, your heirs get a basis of $1.2 million. The built-in gain can literally disappear for income tax purposes. Now, I'm not saying don't ever sell, that would be silly, but maybe you need the money, maybe you really want to downsize, maybe you want to move closer to your family, maybe you don't want the maintenance on that property, maybe you don't want the property taxes, maybe you want to enjoy the equity while you're alive. All of that's valid, but before you sell, at least compare your options. Should I sell it now? Maybe I should look at an installment sale. Should I rent this thing out and just borrow against it? Maybe move it as part of an estate plan. Maybe I transfer it to somebody. Maybe I donate it, get a big old deduction. Maybe I hold it until I pass. All of those are legitimate planning options, and there's not one right answer for everybody. But there's usually a wrong answer, and it's this: sell first. Ask tax questions later. That's how people get smacked around. Don't want to do that. Do some planning ahead of time. Now, let's bring this back to the bill. Would a $1 million home sale exclusion, capital gain exclusion, help people? Absolutely. For some seniors, especially people who bought decades ago in a high appreciated market, it could be a big, big deal. But it's not the law. It's not universal. It's not permanent. And it does not eliminate the need for planning. That current exclusion's been frozen since the 90s. That's a problem. the law did not keep up with the home values. So now normal people, not rich people, not super wealthy, they have taxable gains on homes they simply lived in for decades. But whether Congress fixes that or not, you still need to understand that cascade. We're getting hit with capital gains, Social Security tax, Medicare, IRMAA, NIIT, higher brackets, lost deductions. We just have bad timing. And that's where the real pain can oftentimes come from. And the best moves happen before you sign the closing documents, not after. So if you're thinking about selling a home, or if you have a parent who's thinking about selling, don't just ask, hey, what's the capital gains tax? Ask, what does selling the home do to my entire tax picture over the next few years? That's the question. I'm Toby Mathis. Don't let a frozen 1990s tax rule or a tax surprise 2 years later eat up the equity you've spent a lifetime building. I'll see you in the next one.